Welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today, September 21st, 2025, we're dissecting the GBPUSD pair, which has been at the epicenter of significant global economic shifts and central bank pronouncements. The recent extreme volatility in this pair is largely a consequence of the sharply diverging monetary policies between the Bank of England and the Federal Reserve. Just last week, we observed the US dollar displaying remarkable resilience, bouncing back swiftly despite an initial dip following an FOMC rate cut. Fed Chair Powell's subsequent press conference was perceived as less dovish than expected, and robust US jobs market data further solidified the dollar's strength. Conversely, the British pound has been navigating choppy waters, struggling to maintain its footing against a strengthening greenback. London markets have experienced notable declines, fueled by reports of UK borrowing exceeding official forecasts, which contributed to one of the pound's most significant two-day drops since late July. Although August's UK retail sales data met expectations, the Bank of England's notably cautious stance on potential interest rate adjustments, including a slowed pace of its asset rundown program, stands in stark contrast to the Fed's strategy. This policy divergence creates a fundamental rift that directly translates into the observed instability and intense pressure on GBPUSD. Additionally, a recent proclamation by Donald Trump imposing a substantial annual fee on H-1B visa applications targets the U.S. tech industry directly, potentially carrying long-term implications for overall dollar sentiment, though its immediate impact on GBPUSD might be indirect. It's clear that these macroeconomic forces are deeply intertwined with price action. Now, let's turn to the charts to see their direct manifestation. Starting with the one-day chart for GBPUSD, encompassing data from May 2024 through September 19, 2025, we get a panoramic view of its trajectory. From May 2024, the pair embarked on a significant bullish journey, climbing steadily from approximately 1.25 towards a high near 1.37 by June 2025, indicating a strong underlying uptrend over the past year. However, this upward momentum was interspersed with notable corrections and periods of consolidation, highlighting persistent underlying pressures and bouts of uncertainty. Zooming in on the most recent action, after a strong push towards the 1.365 to 1.372 resistance zone in mid-September, the pair experienced a sharp reversal. The candles on September 17th and 18th showed hesitancy and then a clear rejection from higher prices. Crucially, the daily candle on September 19th delivered a powerful bearish engulfing pattern, opening at 1.35547 and closing significantly lower at 1.34710, with a low of 1.3462. This dramatic drop unequivocally confirms intense selling pressure and directly reflects the news of the pound's recent struggles and instability. The substantial volume accompanying this bearish candle further validates the strength of the sellers, indicating a potential short-term trend reversal. This recent price movement also puts immediate short-term support levels, such as the 1.3462 low and the 1.3380 area from early September, into sharp focus for potential retests. Conversely, the previous resistance levels at 1.3550, 1.3600, and the multi-month high around 1.3720 will serve as formidable barriers for any bullish recovery attempts. It's worth noting that older news referred to resistance at 1.2560 and gains near 1.2700. While these are historical levels from earlier in 2025, they underscore how far the price has moved and the potential for downside if the macro picture deteriorates significantly. This big picture overview sets the stage for our more granular analysis on smaller timeframes. Now, let's hone in on the one-hour chart to examine the intricate intraday dynamics that contribute to such dramatic daily candles. While our available one-hour data concludes on September 4th, 2025, prior to the latest daily candle, it provides an excellent case study of how market volatility translates on shorter timeframes. Let's pinpoint the period between September 2nd, from 7 o'clock Universal Time Coordinated through 12 o'clock Universal Time Coordinated, where we witnessed a rapid bearish capitulation. In a matter of hours, PUSD plunged aggressively from approximately 1.35309 down to 1.33518, showcasing an intense burst of selling activity. This rapid descent, characterized by a series of large, red bearish candles with visibly increased volume, clearly demonstrates how quickly market sentiment can shift and accelerate. Such intraday movements often correlate directly with the immediate market reactions to economic news or central bank announcements, echoing the significant two-day drop mentioned in our news summaries. The breakdown of multiple minor support levels during this period indicates a strong, unimpeded bearish impulse, which is crucial for short-term traders to identify. Understanding these fast-moving hourly patterns is vital for anticipating how broader daily trends are formed and sustained, particularly during periods of policy divergence and uncertainty. This detailed view of past volatility helps us prepare for similar rapid shifts that could occur in the current environment for PUSD. Drilling down further to the 15-minute chart provides even more granularity, allowing us to pinpoint the exact moments of reversal and consolidation. Let's analyze the critical range from September 17, 2025, 17:55 Universal Time Coordinated, into the early trading hours of September 18, 2025, which captures the immediate precursor to the recent daily bearish action. At 17:55 Universal Time Coordinated on September 17, the price briefly touched a high of 1.37264, but the candle's close much lower indicated a strong rejection, signaling this as a potent resistance level. Immediately following, from 1810 Universal Time Coordinated to 1840 Universal Time Coordinated, a barrage of large red candles drove the price sharply down from 1.37201 to 1.36266, confirming a vigorous short-term bearish reversal in action. This cascade of selling volume clearly broke through several intraday support levels, illustrating the speed and intensity with which negative sentiment can take hold. After this initial plunge, PUSD entered a period of consolidation, ranging between approximately 1.362 and 1.359 during the late evening of September 17 and early morning of September 18. This sideways movement, marked by smaller candlesticks, reflects a temporary pause or indecision, as traders either booked profits or awaited further catalysts. However, the subsequent continuation of the downtrend later that day on the daily chart indicates that the underlying bearish sentiment quickly regained control, overcoming any temporary stabilization. For short-term traders, identifying such rapid rejections from resistance and subsequent sharp bearish moves on the 15-minute chart, especially with accompanying volume spikes, is crucial for timely entry and exit strategies. This time frame clearly showed the market's inability to sustain higher prices, reinforcing the overarching theme of the pound struggle. Returning to our one-day chart for a concluding overview, let's recap the critical price levels and discuss potential future movements for PUSD. As of its September 19, 2025, close, PUSD stands at 1.34710, a pivotal point after its recent significant bearish candle. Immediate short-term support is identified at 1.3462, the low of that large September 19 candle. A decisive break below this would be a strong bearish signal. Should this support fail, the next key area to watch is 1.3380, which has acted as a psychological and technical bounce point earlier in September. Further downside targets would include the stronger, longer-term support zone around 1.3200, which has proven significant on multiple occasions. On the upside, immediate resistance is found at 1.35547, the opening price of the bearish September 19 candle, representing the first hurdle for any recovery. Beyond that, key resistance levels are established at 1.3600 and the recent high near 1.3650, which would require substantial bullish momentum to overcome. The multi-month high around 1.3720 remains the most significant long-term resistance, marking the peak of the previous uptrend. Short-term outlook *, we maintain a bearish bias, predicting a moderate likelihood, approximately 60%, of GBPUSD testing the 1.3380 support in the very near future. This prediction is reinforced if U.S. economic data continues its strong run and the Federal Reserve maintains a hawkish tone, while any negative news from the UK economy could accelerate this decline. Long-term outlook *, the picture is more balanced but leans bearish, with a 55% likelihood of further consolidation or a gradual decline towards the 1.3200 area. This scenario is highly probable if the Bank of England persists with its cautious, data-dependent approach, while the Federal Reserve remains firm on its tightening path. A strong long-term bullish reversal, with a likelihood of 45%, would necessitate a significant shift in this fundamental divergence, such as unexpected hawkishness from the bow or a clear dovish pivot from the Fed due to weakening U.S. economic indicators. Traders should closely monitor inflation reports from both economies, GDP figures, and, crucially, any forward guidance from central bank officials. A sustained break below 1.3462 could trigger accelerated selling, making it a critical trigger point for short positions. Conversely, a strong close above 1.35547 on the daily chart would suggest that the immediate bearish pressure is easing, potentially signaling a short-term relief rally. Always implement robust risk management strategies, considering stop losses and position sizing appropriate for your trading plan. Combining multi-timeframe technical analysis with a keen eye on global fundamental developments is your best defense and offense in this volatile market. Thank you for joining Explain the Charts, and we look forward to our next deep dive into the markets.